Digital rupee and cryptocurrency are two forms of digital money that are often discussed together, but they are quite different in nature. While both exist in electronic form and aim to make transactions easier, they differ mainly in terms of control, stability, and purpose. Understanding this difference helps in seeing how the future of money is evolving. Digital rupee vs cryptocurrency and their key features have been discussed in detail in this article. Digital rupee vs cryptocurrency. Digital forms of money are evolving with the rise of the digital rupee and cryptocurrencies. The digital rupee, issued by the Reserve Bank of India, is an official and regulated currency, while cryptocurrencies like Bitcoin operate independently using technologies such as blockchain. Despite both being digital, they differ in control, stability, and purpose. Digital rupee vs cryptocurrency. Basis: Digital rupee, CBDC. Cryptocurrency. Issuer: issued and fully regulated by the Reserve Bank of India, making it an official currency. Not issued by any government or authority, created and maintained by decentralized networks. Nature: it is the digital form of fiat currency, similar to physical cash but in electronic form. It is a privately created digital asset that exists only online. Legal status: recognized as legal tender in India and must be accepted for payments. Not recognized as legal tender, acceptance depends on users or merchants. Control: central bank has complete control over its supply, circulation, and value. No central control, operates independently based on network rules. Value stability: stable in value as it is directly equal to the Indian rupee. 1 Indian rupee equals 1 Indian rupee. Highly volatile, prices fluctuate based on demand, supply, and market trends. Backing: backed and guaranteed by the government/central bank, ensuring trust and reliability. No official backing, value depends on user trust and market perception. Technology: generally uses a centralized or permissioned system, may use blockchain for records. Based on decentralized blockchain technology like blockchain. Security: secured through regulated systems and institutional safeguards. Uses cryptography for security but can face risks like hacking and fraud. Regulation: fully regulated and monitored by government authorities. Largely unregulated or loosely regulated in many countries. Purpose: designed for everyday payments, settlements, and improving financial efficiency. Mainly used for investment, trading, and as an alternative asset. Anonymity: offers limited and controlled anonymity for users. Provides relatively higher anonymity, though transactions are recorded publicly. Supply control: supply is managed by the central bank based on economic needs. Supply is often fixed or algorithm-based, example Bitcoin has a limited supply. Digital rupee. Meaning of e-rupee: the e-rupee is the digital form of India's physical currency. It has the same value as paper money and coins, and can be exchanged one-to-one with them. In simple terms, it is like carrying cash, but in a digital form. Issued and controlled by the central bank, the digital rupee is issued by the Reserve Bank of India and is a direct liability of the central bank. This makes it safe and reliable, unlike private digital currencies. Legal tender and universal acceptance: it is a legal form of money, which means it must be accepted by everyone, individuals, businesses, and government institutions. It can be used for payments, savings, and daily transactions just like cash. Easy to use and convert: the e-rupee can be easily converted into cash or bank deposits whenever needed. It is also designed in a way that even people without a bank account can use it, improving access to financial services. Cost-effective and efficient: by reducing the need to print and manage physical cash, the e-rupee can lower costs for the government. It also enables faster and smoother digital transactions. No mining and no interest: unlike cryptocurrencies such as Bitcoin, the e-rupee cannot be mined and is fully controlled by the RBI. Also, it does not earn interest when held. Privacy with limits. The RBI has proposed partial anonymity. Small transactions may remain private, but larger transactions can be tracked to prevent misuse. About CBDC, Central Bank Digital Currency. Basic concept: CBDC is a digital version of a country's official currency issued by its central bank. It works just like physical money but in electronic form. Main features: it is secure, acts as a medium of exchange, store of value, and unit of account. Each unit is uniquely identifiable, which helps prevent fraud. Instant transactions. Transactions using CBDC are expected to be faster and more efficient compared to current digital payment systems. Versions of CBDC. Retail CBDC. CBDC this version is meant for the general public, including individuals and businesses. It allows people to make everyday payments using digital money that is directly backed by the central bank. Wholesale CBDC. CBDCW This version is designed for banks and financial institutions. It can make interbank payments faster, more secure, and more efficient. Forms of CBDC. Token-based CBDC. This works like physical cash, where ownership depends on who holds the digital token. It is simple and suitable for everyday transactions. Account-based CBDC. This system records balances and transactions in accounts. Ownership is verified through identity, similar to how bank accounts work. Models of issuance. Direct model. Single tier in this system, the central bank handles everything, including issuing the currency, managing accounts, and verifying transactions. Indirect model. Two-tier here. The central bank issues the digital rupee, but banks and intermediaries manage user accounts and transactions. CBDC need. Growing use of digital payments. Although digital payments are increasing, cash is still widely used, especially for small transactions. CBDC bridges this gap. Reducing cost of cash management. Managing physical currency is expensive. A digital alternative can reduce these costs significantly. Response to cryptocurrencies. The rise of digital currencies like Ethereum has created the need for a secure, government-backed digital option. Key benefits of eRupee. Faster financial system. It can improve the speed of money transfer across banks and users, making the overall system more efficient. Promotes financial inclusion. It can help people without full access to banking services to participate in the digital economy. Better monetary control. It gives the central bank more effective tools to manage money supply and economic policies. Supports global transactions. The digital rupee can also help improve cross-border payments and strengthen India's position in digital finance. Cryptocurrency. Meaning. Cryptocurrency is a type of digital money that exists only in electronic form. It uses advanced coding techniques, cryptography, to make transactions secure and to control how new units are created. No central authority. Unlike traditional currencies issued by central banks, cryptocurrencies are not controlled by any government or authority. They operate independently through a distributed network. First cryptocurrency, Bitcoin, launched in 2009, was the first widely used cryptocurrency and remains the most well-known example today. Stored on blockchain, transactions are recorded on a public digital ledger called blockchain, which keeps a transparent and permanent record of all exchanges. Working of cryptocurrency. Decentralization. Cryptocurrencies run on a network of computers, called nodes, spread across the world. No single authority controls the system, which reduces dependence on banks or governments. Blockchain technology. All transactions are grouped into blocks and linked together in a chain. This system ensures that records cannot be easily changed, making the data secure and trustworthy. Use of encryption. Cryptographic tools like public and private keys, digital signatures, and hash functions are used to protect transactions and verify ownership, ensuring safety and privacy. Smart contracts. Some cryptocurrencies, like Ethereum, allow the use of smart contracts. These are self-executing agreements that automatically carry out transactions when certain conditions are met, without needing intermediaries. Limited supply. Many cryptocurrencies have a fixed supply. For example, Bitcoin has a maximum limit, which makes it scarce and often compared to digital gold. Mining process. New units of cryptocurrency are created through a process called mining, where powerful computers solve complex mathematical problems to validate transactions and add them to the blockchain. Consensus mechanism. Transactions are verified through agreed rules called consensus protocols. For instance, Bitcoin uses proof of work, where participants compete to solve problems and earn rewards. Types of cryptocurrency. Payment cryptocurrencies, used for direct peer-to-peer payments without intermediaries. Examples include Bitcoin and Bitcoin Cash. Stable coins, linked to stable assets like traditional currencies to reduce price volatility. Examples, USD Coin, Tether. Utility tokens, provide access to services or products within a blockchain platform, such as Filecoin and Chainlink. Security tokens, represent real-world assets like shares or bonds in digital form and are often regulated. Governance tokens, allow users to vote on decisions related to a blockchain project. Example, MakerDAO. Central bank digital currencies, CBDCs, digital form of official currency issued by central banks, such as ECNY, digital yuan.